Well, Asian markets, they are trending higher after an overnight bounce on Wall Street. All eyes now are on the G-20 summit. That's set to take place in Argentina later this week, where President Donald Trump and President Xi Jinping, they are due to meet. So all eyes out there. Can they call for a trade truce? That's something that everyone's looking forward to. But for the time being, most of those markets are trading with some green. The Nikkei, that's sitting with a gain of around 0.2%. Remember, besides the positive global setup, you also have the yen. That's a bit of a tailwind out there. That's moved to around 113.5 odd. Remember, just a few trading sessions ago, it was at around the 112.5 odd mark. The Kospi, though, that's come off the high point of the day. We're sitting with a gain of around 0.2%. So keep an eye out on that one. I think the other couple of markets as well have flattened out, and both of them are sitting with some cuts now. So Asian markets off the high point of the day. And for starters, the SGX Nifty is indicating maybe, in fact, we'll give back close to around half of what we put on yesterday. Interesting to see whether or not that happens. But for the time being, the SGX Nifty is indicating a 50-point downtick.
Well, yes, naturally mentioned all eyes are on G20 summit. An important commentary coming ahead of that, wherein Donald Trump said in an interview that it is highly unlikely that he would not go ahead with putting tariffs on January 1. And this comes ahead of the G20 meeting, which is lined up for this week. And there were also comments regarding a 10% tariffs on Apple products from China. So that is perhaps kind of a niggling worry, and that's the reason perhaps Asia is off highs. But otherwise, in the US markets, the stocks closed higher as beaten down tech stocks rebounded from steep losses. Now, last week, the Dow Jones rose, yesterday actually, Dow rose over 350 points, posting its biggest gain since November 7th, while the S&P 500 gained around 1.5%. The Nasdaq Composite outperformed, and that index rose by over 2%. Stable oil prices also aided sentiment. CNBC's Eric Shemi gets us a wrap of all the action on Wall Street.
U.S. stocks starting the week with a bang. The Dow adding 354 points, the S&P up 40, and the Nasdaq up by 142. General Motors saying it will lay off more than 14,000 employees and halt production at several North American plants next year. Those plants are in Ohio, Michigan, Maryland, and Ontario. GM says the move will save roughly $6 billion by 2020. President Trump telling reporters he was not happy with the news. Shares of GM, though, up nearly 5% today. Online shoppers doing some serious buying this Cyber Monday. Sales expected to top $7.8 billion today, according to Adobe Insights. That makes it the largest online shopping day in U.S. history. It comes off a strong showing on Thanksgiving and Black Friday, when Adobe says online shoppers bought nearly $10 billion worth of goods. And IBM CEO Ginni Rometty calling for regulation of consumer-facing tech companies like Facebook, Google, and Amazon. Though she did not directly name the companies, in a speech to EU commissioners, Rometty said that irresponsible handling of personal data by those companies should, quote, not define the digital economy. That's the action from the U.S. market. Back to you in Mumbai.
Okay, on that note, here is some opinion from Morgan Stanley and Citi on the road ahead for the U.S. market and how factors like lower crude prices and Fed's rate trajectory will impact the emerging market action, including India.
We have a below consensus growth forecast for the U.S. economy next year. We have U.S. growth slowing all the way down to a 1% annualized growth rate in the third quarter. And so we think that that, one, will reduce overall optimism towards U.S. assets, but specifically result in a pretty large deceleration in earnings growth for the S&P 500 from the current level of a 20-something% year over year for S&P earnings to just maybe 4% year over year next year. So a slower economic backdrop, weaker earnings growth, you couple that with continued tightening in the first half of next year from the Fed, and I think it's all a cocktail for a much more difficult outlook for U.S. equities relative to the rest of the world. We think the outlook in India is relatively attractive, given what's been happening with oil prices recently. We actually think the outlook in China next year could be somewhat better than low expectations currently say. We see odds that we'll see further fiscal stimulus there that will help stabilize the economy and stabilize growth. You have had an enormous repricing of EM assets, and again, the price matters. You've had a very significant derating of EM equities. You've had a very significant, even on the fixed income side, widening of credit spreads. So, look, EM still has challenges. It's still going to have fundamental challenges next year, but the price is a lot better.
Price of oil will determine what's going to happen in terms of E&P activity. Number two, is the idea of the Iran deal and the exemptions, 800,000 barrels, was not expected by the market, so there's more supply in the market than what had been anticipated. And lastly, there has been some sluggish demand, but primarily it coming out of non-U.S. marketplaces, particularly China, where there's been some weakness, and that's been kind of the incremental driver for more demand. So energy's been under pressure from a number of different perspectives. The lower price is a clearing mechanism. Is it good for consumers? Yes. Is it bad for Texas economy? Yes. So it's kind of a little bit of a push either way. Our global view is that emerging markets have some opportunity as well. U.S. has been a bit of a safe haven market relative to the world. The economy is stronger here. We got the buyback activity here. We've got a stronger economy here. All those are very important dynamics. What I would suggest to any investor who's trying to think about global positioning is look at the dollar. If you have a very strong view on the dollar going higher, U.S. tends to outperform emerging markets, tends to outperform everywhere in the world.
Well, tech and industrials, they have been the worst hit in the recent market correction. Now, these are sectors that were responsible for market highs when Donald Trump was elected as the president. Now, as Steve Leavesman reports, that there may be a case of money exiting from both the sectors, and it may also be raising broader concerns on the administration's policies. Let's listen.
The old saying goes, the harder they come, the harder they fall. That may apply to sectors that have led the charge since the election of President Trump. They have mostly led the market lower since the top on October 3rd. So is it just a case of the market correcting itself or overbought sectors selling off, or have investors fallen out of love with the Trump trade? The top three sectors since the election gained 51%. They're now down 11%, while the bottom three sectors were up only 3.4%. They're off 2%. Looking specifically at sectors, it was IT that led the market higher, 67% from the election through the top on October 3rd. It's down 15%. The leading sector up and the leading sector down. The number two spot goes to consumer discretionary, up 47% and down 13%. The Trump administration says the benefits of tax cuts will build over time. It'll prompt companies to invest, boost productivity, and also increase worker wages. But among the sectors that would benefit most from this, industrials, they were up 33% from the election. They're now off 12%. And Morgan Stanley, broadly pessimistic about earnings next year. In a commentary, they wrote, quote, there is a greater than 50% chance we experience a modest earnings recession in 2019. This growth disappointment is likely to be offset somewhat by a Fed that pauses its rate hike campaign by June. Now, it could be that all the trade disputes are troubling the market, along with concern over the Fed and higher interest rates. But the optimistic view that the upside of tax cuts would reduce the downside from these other issues seems to be at least an open question in markets today.
Well, in European markets, they entered in positive territory. Investors out there, they digested the fresh developments surrounding the Brexit after European Union backed Prime Minister Theresa May's deal. Now, the rebound in oil prices as well, that as well helped boost sentiment. So all the three frontliners, they ended in the green. But it wasn't just the frontliners. The Italian index, that was up more than 2.5% yesterday on hopes that the government may be able to find some sort of a common ground with the European Union over its budget. So that market, in fact, was a big outperformer yesterday, up close to around 2.8%, nearly around 3% is the run we saw there.
Okay, and in the world of commodities as well, the oil prices clawed back some of the steep losses that we saw in the last 7 weeks and rose nearly 3% overnight. Now, prices fell to their lowest levels in more than a year over the weekend amid growing concerns and worries of an oversupply in the oil market. Remember, OPEC and its allies are set to meet in Vienna next month, that is on December 6th, and they are expected to announce that output will be curtailed.
And in the precious metal space, gold prices hold. They are supported by uncertainty over the pace of U.S. interest rate hikes. And also all eyes on the outcome of the G-20 summit later this week, when political leaders will focus on the current global trade tensions.
Okay, it's time now for a break on the show. The first one, we'll take a short break. Come back, we'll tell you all the cues and news you need to know for trade this Tuesday morning. Stay tuned.